Right now, I mean, the consumer economy is just an absolute bloodbath.
Oh, without a doubt. It's rough out there.
You look at the landscape and, S&P benefits have been severely slashed. Millions of households have just completely exhausted whatever pandemic-era savings they had left.
Yeah, that safety net is totally gone for a lot of people.
Exactly. And then, on top of all that, you have sustained $4 a gallon gas prices, which, frankly, acts as this brutal regressive tax on the working class.
Right. And so logic dictates that in this specific macroeconomic environment, retail should be cratering.
It should be, yeah.
But here is the ultimate retail paradox. The fastest growing demographic walking through the doors of the local discount store right now are actually households making over $100,000 a year.
Wait, really? Six-figure households?
Yep. You have the consumer base that theoretically should be the most insulated from inflation, totally altering their behavioral patterns. They are actively driving traffic at the very bottom of the retail pricing funnel.
That is wild. And that paradox brings us to the subject of today's deep dive. We are looking at Dollar General, ticker symbol DG.
Specifically, we're breaking down their Q1 2026 earnings call transcript.
Right. And for you, the retail investor listening to us right now, our mission today is pretty straightforward. We want to bypass the corporate PR spin, isolate the verifiable data, and give you a clear, actionable verdict on whether the stock is a buy, a hold, or a fold.
Because honestly, what Dollar General reported this quarter completely fractures the conventional wisdom of how a discount retailer is supposed to operate during an economic downturn.
It really does. But, we can't just take the headline numbers at face value.
Definitely not. I mean, the retail graveyard is totally full of companies that posted one strong quarter based on unsustainable pricing power or crazy aggressive discounting.
Right. So to understand the actual longevity of this momentum, we have to look under the hood at the operational mechanics that are actually driving these numbers.
So let's start exactly there. Let's look at the top and bottom lines.
Okay, pulling straight from the transcript. Dollar General's net sales jumped 3.4% to $10.8 billion for the quarter.
Which is a massive top-line number.
Yeah. And diluted earnings per share, their EPS, spiked an impressive 12.4% to $2 flat per share.
And management explicitly noted on the call that this EPS beat the high end of their internal expectations.
But I think the context around that $10.8 billion top line is what makes it super compelling.
Oh, absolutely. The weather factor.
Right. They achieved this growth despite starting the quarter in February facing severe winter storm activity. And that forced the temporary closure of thousands of their stores.
And that weather headwind is a really crucial data point for us when we're evaluating the underlying demand.
How so?
Well, when you run a retail operation with over 18,000 locations, a massive weather event doesn't just mean a slow Tuesday.
Right. It's not just dip in traffic.
No, it means millions of dollars in lost transaction windows that you can honestly never fully recover. I mean, a consumer doesn't go back and buy the milk they would have bought 3 days ago during a blizzard.
Yeah, that sale is just gone.
Exactly. So for Dollar General to lose a significant chunk of operating hours in February and still post a 3.4% top-line expansion, it tells us the velocity of sales in March and April wasn't just strong.
It had to be a tidal wave to make up that gap.
Right. They didn't just meet their targets, they totally outran a massive structural deficit.
Okay, but total net sales can be a mirage if a company is just, aggressively expanding its real estate footprint.
Oh, for sure. You can always just buy revenue by opening more doors.
Right. So the metric that actually dictates the health of the business is their same-store sales, which Wall Street calls comps.
And Dollar General reported a 2% growth in comps.
Which, in an environment where major big box peers are reporting flat or even negative comps, a 2% expansion is huge. It means their existing real estate is sweating harder and pulling in more capital.
Yeah, and it proves that the actual concept of their physical footprint remains highly relevant. That 2% comp growth is it's the truest indicator of organic business health.
Because it strips out the new stores, right?
Exactly. It isolates the stores that have been open for at least a year and measures their year-over-year performance, completely stripping away the artificial growth of new grand openings.
Okay, but here is where I have to step in and look at this with an investor's skepticism.
Go for it.
We are living in an era of super sticky inflation. The cost of raw materials, freight, consumer packaged goods, it's up across the board.
Unquestionably.
So is this 2% comp growth just an illusion created by inflation?
What do you mean?
Well, if Dollar General simply raises the price of a can of soup by 15 cents to cover their own rising costs, their revenue technically goes up. So are actual human beings engaging with the business more frequently, or are we just looking at the math of inflated price tags padding the register?
That is the definitive question for retail right now. And the transcript gives us the exact traffic data to answer it.
Okay, what are the numbers?
Customer traffic actually grew by 1.4% in the quarter.
Oh, wow.
Yeah. And furthermore, the average basket size, so the total amount of goods purchased per transaction, that grew by 0.5%.
Okay, so it's not just a pricing illusion then. There is physical, measurable volume growth happening here.
Precisely. More actual people are walking through the doors, and they are putting slightly more physical product into their carts.
Which is the exact opposite of what you'd expect right now.
Right. Management specifically highlighted that this marks the fourth consecutive quarter of traffic growth for them.
While the rest of the industry is seeing foot traffic basically evaporate.
Exactly, because the average consumer is consolidating their trips to save on gas. But Dollar General is seeing accelerating frequency.
Okay, but to completely dismantle the bearish argument that they're just passing along inflationary costs to survive, we really have to examine their gross profit margin.
Good point. Because if a retailer is merely using price hikes to outrun their supply chain costs, their gross margins will just remain flat or even contract.
Right, because their cost of goods sold is rising right in tandem with their prices. But their gross profit margins didn't contract.
No, they didn't. They actually expanded by 65 basis points.
Pushing it to 31.6%.
Which is huge.
It really is. I mean, in the absolute razor-thin margin ecosystem of discount retail, squeezing an additional 65 basis points out of the operation is an enormous leap in profitability.
It's a massive indicator of leverage. Mechanically, expanding margin by that magnitude in an inflationary cycle means they are seriously optimizing their procurement strategy.
They're negotiating from a position of power with their vendors.
Right, and they're shifting their product mix toward higher margin items. So they aren't just blindly taking price hikes from suppliers. They are capturing more pure profit out of every single dollar that crosses the counter.
Okay, so the margin expansion proves this isn't a fluke. The structural health of the business is pristine. But, that begs a massive behavioral question for me.
Which is?
In an economy where the core discount shopper is financially suffocating, who exactly has the disposable income to drive this volume?
And this is where we arrive at that demographic data management shared, which I think fundamentally redefines Dollar General's position in the broader retail hierarchy.
The $100,000 earner.
Exactly, because their core low-income rural customer is absolutely making tough trade-offs right now. But the catalyst driving this outsized growth is a massive influx of what they call trade-in customers.
Right, people trading down for more expensive stores.
Yeah. They noted the largest increase in customer count came specifically from households earning over $100,000 a year.
Which is that glitch in the matrix I mentioned earlier. You have households pulling in six figures, aggressively shifting their weekly shopping routines to Dollar General. It feels upside down.
It does, but we have to look at the psychology and really the balance sheet of the modern six-figure household.
True, 100 grand doesn't go as far as it used to.
Earning $100,000 a year does not carry the purchasing power it did even 5 years ago.
Right.
When you factor in the explosion in mortgage rates, the massive spike in auto insurance,
Sustained childcare costs, the general inflation of utilities. Yeah, the upper middle class balance sheet is incredibly constrained right now.
Exactly. That demographic is actively leaving the premium supermarkets and the traditional expensive drugstores. They are just hunting for relief.
And I think there is a massive erosion of the social stigma that used to surround discount shopping, too.
Oh, absolutely. For the affluent consumer, trading down is no longer seen as a desperation move. It's viewed as like a savvy financial strategy.
And Dollar General has built the exact merchandising trap to capture that specific consumer.
And that trap is built entirely around the psychology of the literal $1 price point.
Which is so interesting because their competitors have largely abandoned the single dollar. They've moved to $1.25, or they use variable pricing models.
But Dollar General is fiercely defending that $1 mark. They have curated a whole section called Value Valley.
Value Valley is just brilliant retail architecture. It's this rotating selection of approximately 500 items strictly priced at $1.
And that contributes to a total store selection of over 2,000 items at or below that single dollar threshold.
And the performance data on this specific strategy is staggering. Value Valley drove an 18.4% comp sales increase this quarter.
Wait, let's contextualize that for a second. An 18.4% comp increase on a specific segment within a mature retail store is almost structurally impossible.
Right, unless you have totally tapped into a core behavioral driver.
Which they have. I mean, they are leaning into this so heavily that they have rolled out dedicated frozen food sections, like entire rows of commercial freezer doors stocked exclusively with $1 items.
Let's break down the mechanics of that, because executing a $1 frozen food strategy is incredibly difficult from an operational standpoint.
Oh, it's a nightmare. Running a commercial cold chain requires massive capital expenditure.
Yeah, you have the upfront cost of the freezer units themselves, then the constant energy drain to keep them running.
Plus the specialized refrigerated freight logistics to get the product from a distribution center out to a rural town, and the extremely high risk of spoilage.
Exactly. To make the unit economics work on a $1 frozen pizza or a bag of frozen vegetables, your inventory turnover velocity has to be absolute lightning.
The only way you don't bleed cash on a $1 frozen item is through immense scale and rapid depletion.
Right, because you're making literally pennies on the margin per unit.
So you need the customer to buy 5 or 6 of them at a time, constantly clearing out those doors.
And here is why that velocity is actually happening. It sounds like the $1 item serves two completely different behavioral functions depending on the tax bracket of the shopper.
How do you mean?
Well, think about the $100,000 trade-in customer. For them, the Value Valley aisle is a treasure hunt. It provides this low-risk dopamine hit.
Right.
They walk in for a household cleaner, wander past the dollar section, and toss a seasonal decoration or a recognizable brand name snack into their cart simply because it's $1. It feels like a victory.
Yeah, it's an impulse buy that pads the overall basket size and boosts those margins. It acts as an incredibly effective basket builder because the friction of the purchase decision is practically zero.
Exactly. But contrast that with the core low-income Dollar General shopper.
Right.
The customer who, as management pointed out on the call, literally runs out of money before the end of the month.
Yeah.
For that demographic, the $1 frozen food door isn't a treasure hunt at all. It is a lifeline to balance the household budget.
It becomes a mathematical necessity for household survival.
Exactly. When SN8 benefits are exhausted by the third week of the month, and you have exactly $8 left in your checking account to feed your family until payday, the Dollar General frozen aisle offers predictable math.
$1 for frozen protein, $1 for vegetables, $1 for pasta.
Right. It bridges the gap. The exact same SUs say that $1 bag of frozen broccoli is an impulse novelty for the affluent shopper and a vital caloric necessity for the low-income shopper.
That is fascinating. And that dual utility is the engine behind their 1.4% traffic growth. They are simultaneously extracting discretionary capital from the wealthy and providing essential relief to the financially strained.
And they're doing it without the merchandising for one alienating the other.
Right. But, the reality of relying on a high volume of $1 transactions is that your margin for error is basically non-existent.
Oh, for sure. If you run a sloppy operation, you will just bleed out.
Which brings us to a critical operational metric that really separates Dollar General from the rest of the retail sector right now, and that's shrink.
Shrink.
Yeah.
Yeah, Wall Street jargon for theft, loss, and damage.
Shrink is the absolute terror of the retail industry today.
It encompasses everything, right? Organized retail crime, casual shoplifting, internal employee theft.
And even administrative errors like damaged goods or supply chain miscounts.
Right now, you honestly can't listen to a big box retail earnings call without hearing executives blame shrink for missing their margin targets.
No, it's the universal excuse.
Yeah.
Massive chains are retrofitting their stores, locking basic commodities like deodorant, shaving cream, and laundry detergent behind plexiglass cabinets just to stop the bleeding.
Which fundamentally degrades the consumer experience.
Yeah.
I mean, if a customer has to press a call button and wait 10 minutes for an employee to unlock a $3 tube of toothpaste, the friction often causes them to abandon the purchase entirely.
Yeah, they just walk out. But Dollar General's transcript reveals a stunning divergence from this industry trend.
They didn't just plateau their shrink rate, they actually reduced it.
Right. Shrink was down 28 basis points this quarter. And to put that in perspective, the CFO noted they achieved this 28 basis point reduction while lapping a massive 61 basis point improvement from the exact same quarter last year.
So they are stacking compounding wins in literally the hardest operational category in retail right now.
Exactly. To understand how they're defying the macro trend, we have to look at the mechanisms of their inventory control.
Right, because you don't reduce shrink by 28 basis points by simply hiring more security guards.
No, you do it through systemic operational efficiency. The transcript noted a 1.6% reduction in per-store inventory levels.
And I think that 1.6% reduction is the key. When we talk about shrink, everyone immediately pictures a shoplifter running out the front door.
Right, the viral videos.
Yeah. But a massive percentage of shrink is operational. It's a pallet of merchandise sitting in a cluttered backroom that gets crushed by a forklift.
Or it's seasonal inventory that gets lost in a disorganized stockroom and expires before it ever even hits the sales floor.
Precisely. By tightening their inventory flow and reducing the physical amount of products sitting idle in the store, they achieve multiple operational victories.
First, a leaner backroom means employees can actually find and process the freight quickly, which reduces damage.
And second, it allows employees to spend less time unloading trucks and more time actually out on the sales floor.
Which acts as a natural deterrent to external theft. I mean, the best loss prevention strategy in a small format store isn't a locked cabinet.
No, it's an employee standing in the aisle providing customer service.
Exactly. Furthermore, optimizing that inventory directly contributes to that 65 basis point gross margin expansion we talked about earlier.
Because every single unit of merchandise that isn't stolen or crushed in the back room drops its entire margin straight to the bottom line.
It is a masterclass in operational discipline. But, they aren't just locking down their internal operations. They are actively expanding their reach through a mechanism that is entirely transforming convenience retail.
You're talking about the delivery network.
Yes. We need to discuss the impact of their delivery ecosystem.
This might honestly be the most underappreciated catalyst in their entire portfolio right now. Delivery contributed a massive 70 basis points to their overall 2% same-store sales growth.
Think about that. Over a third of their comp growth is being generated by people tapping an app on their phone.
To grasp the magnitude of this, you really have to look at their infrastructure. Dollar General is currently offering delivery from approximately 18,000 of their locations.
And they're utilizing their own MyDG app, integrated with third-party logistics networks like DoorDash and Uber Eats.
Which is fascinating because we generally associate app-based delivery with dense urban environments. You order a pizza in the city.
Right. You don't normally picture a DoorDash driver delivering a bottle of shampoo and a pack of diapers in a rural town of 3,000 people.
But Dollar General has quietly constructed what is basically the most expansive network of micro-fulfillment centers in the country.
Because Amazon and Walmart are spending billions of dollars building massive automated distribution warehouses just to shave hours off their delivery times to rural consumers.
And Dollar General doesn't have to build those warehouses because they are already physically embedded in those exact neighborhoods.
Right. Management stated they have a storefront within 5 miles of 75% of the United States population.
That is a crazy statistic. And because the physical distance between the store and the consumer is so short, the unit economics and the speed of delivery become highly disruptive.
The COO highlighted that 80% of their delivery orders arrive in under an hour.
Wow.
And more importantly, 40% of those deliveries arrive in under 30 minutes.
Delivering a basket of consumer staples to a rural household in under 30 minutes completely alters the purchasing psychology.
It totally transitions the transaction from a planned weekly grocery trip into an immediate impulse fulfillment of a localized need.
Right. If a consumer is cooking dinner and realizes they are out of cooking oil, they are no longer loading their kids into the car and driving 15 minutes to a supermarket.
No, they hit the MyDG app and 20 minutes later, a driver is pulling into their driveway.
But let's look at the financial mechanics of that specific transaction for a second, because paying a delivery fee and a driver tip on a small basket of cheap items seems counterintuitive.
Yeah, how does the consumer justify it? And how does the driver even make a profit?
Right.
Well, the driver economics work specifically because of the proximity. If a DoorDash driver only has to travel 2 miles from the Dollar General to the house, they can batch multiple deliveries in a single hour.
Making the route profitable for them.
Exactly. And on the consumer side, the presence of that delivery fee introduces a behavioral friction point that actually benefits Dollar General.
Because of basket padding, right?
Exactly. To justify paying a $5 delivery fee, the consumer naturally engages in basket padding.
They think, well, if I'm already paying for delivery for this cooking oil, I might as well add a case of water, some paper towels, and a bag of chips to make the fee worth it.
And the transcript explicitly confirmed this. They are seeing significantly larger basket sizes on delivery orders compared to in-store transactions.
So it is highly incremental revenue.
Yeah. These aren't existing in-store customers shifting to digital and cannibalizing the physical foot traffic. These are entirely new, highly profitable transaction occasions that Dollar General previously just could not capture.
Okay, so to summarize the operational picture here before we look forward.
Yeah.
They have the affluent shopper trading down, the core shopper utilizing the $1 lifeline.
They are structurally reducing shrink while the rest of the industry bleeds.
And they are leveraging an 18,000 store physical footprint to execute 30-minute rural delivery.
It's phenomenal defense and highly aggressive offense at the same time.
It really is. But as we know, the market is inherently forward-looking.
Always. The retail graveyard is also full of companies that had one great quarter and then immediately guided down for the rest of the year.
So we have to examine what management is projecting for the remaining quarters of 2026. What are they signaling to Wall Street?
Well, that brings us to their management guidance, and the signal they sent was incredibly aggressive. They raised their outlook across every major metric.
Oh, wow.
Yeah. They bumped their full year earnings per share forecast up by a full 10 cents. They're now projecting an EPS range between $7.20 to $7.45.
Raising full year guidance after only the first quarter is a pretty definitive statement of confidence.
It really is. It communicates to the institutional investors that the momentum they saw in March and April wasn't just a temporary weather rebound, but a durable, systemic acceleration of the business model.
Did they raise revenue targets too?
Yes, they raised their top-line projections, forecasting net sales growth between 3.7% and 4.2%.
Okay. And comps?
They're projecting full-year same-store sales to grow between 2.2% and 2.7%.
And that same-store sales projection is definitely the most critical piece of that guidance.
Because the CFO acknowledged that the year-over-year comparisons become significantly tougher in the back half of the year, right?
Right. They are going to be measured against very strong historical quarters, yet they are still modeling an acceleration. To justify that kind of forecast, you have to possess incredibly powerful operational levers.
And they detailed exactly what those levers are on the call. You don't just hope your way to a 4% revenue expansion, No,
you engineer it through capital allocation. And it sounds like their primary engine for this future growth is a massive, highly structured store remodeling initiative.
Segmented into two distinct strategies, Project Renovate and Project Elevate.
Let's break down the mechanics of these remodels, because this is where the capital expenditure translates directly into compounded daily returns.
Okay, so Project Renovate is their aggressive, heavy lift remodel. This targets stores that are roughly 7 years old or older.
Right, so this isn't just a fresh coat of paint.
No, it is a total floor-to-ceiling modernization. They are completely altering the store layout.
And I noticed the crucial element of Project Renovate is the aggressive expansion of the cooler doors.
Exactly. They are vastly increasing their capacity to hold fresh produce, dairy, and frozen goods.
And we just discussed how highly profitable that expanded frozen section is when it's driven by that $1 price point.
By adding more cooler capacity, they directly increase the frequency of the customer's visits.
That makes perfect sense. If a store only sells dry goods, a customer might visit once every 2 weeks. But if that same store now offers fresh produce and expanded dairy, it suddenly becomes viable for the midweek grocery fill-up.
And Dollar General is executing a staggering 2,000 Project Renovate remodels this fiscal year alone.
2,000.
Yeah, and they already completed over 650 of them in the first quarter.
Wow. And the return on investment math for these is pretty bulletproof, right?
It is. Historic data shows a Project Renovate remodel yields an annualized same-store sales lift of approximately 6%.
That is a massive lift per store.
It is. And then you layer in Project Elevate, which is their lighter touch strategy.
For mature stores that don't quite need the heavy-duty structural changes yet.
Exactly. Project Elevate touches about 80% of the sales floor, really focusing on optimizing product adjacencies, making sure the chips are next to the soda and modernizing the category layouts.
And how many of those are they doing?
They are executing 2,250 of these Project Elevate remodels this year.
And what's the historical lift on those?
Those historically yield a 3% sales lift.
Okay, so combined, you are looking at over 4,200 store remodels in a single 12-month window.
That's a massive undertaking.
Yeah. That scale of capital reinvestment ensures that their physical real estate remains highly productive. It actively prevents that natural sales decay that happens as a store ages.
And management also noted a secondary internal benefit to these remodels: employee retention.
Oh, absolutely. Working in a modernized, efficiently laid out store is vastly superior to wrestling with freight in a cramped, outdated building.
Right. In a retail environment where labor costs are super high and hiring is difficult, giving your store managers a better facility really reduces turnover.
And in retail, manager continuity directly correlates to lower shrink and higher localized profitability.
It's a holistic upgrade to the unit economics. But while the remodels fortify the physical locations, there was a deeply strategic detail buried in the transcript regarding their digital ecosystem.
The subscription pilot.
Yes. And this could fundamentally alter their valuation multiple.
The COO briefly mentioned that later this year, they are planning to launch a delivery subscription pilot program,
which is Dollar General essentially building a localized rural version of Amazon Prime.
And the behavioral economics of a retail subscription model are incredibly powerful.
Oh, definitely. Currently, their delivery network is purely transactional. The customer makes a conscious decision to absorb a delivery fee every single time they order.
But if Dollar General successfully transitions that customer to a flat monthly or annual fee for unlimited delivery, it triggers the sunk cost fallacy.
Exactly. Once a consumer has prepaid for access to a delivery network, their psychological mandate is to extract maximum value from that investment.
They want to get their money's worth.
Right. So instead of cross-shopping at Walmart or ordering household staples from Amazon, the consumer's default zero-friction response for every single household need becomes simply opening the MyDG app.
It creates this impenetrable moat of digital loyalty. It locks the consumer into their ecosystem, guaranteeing a recurring revenue stream while simultaneously capturing 100% of that household's routine consumable spend.
And they are synergizing this digital loyalty with their newly launched DG Media Network,
which is huge. Retail media networks are currently the most lucrative secondary revenue streams in the entire industry.
By funneling millions of highly loyal subscribed shoppers through their app, Dollar General gains a massive trove of localized purchasing data.
And they then turn around and monetize that exact data by selling highly targeted premium advertising space within the app.
To their massive brand partners, right? The Procters & Gamble's and the Coca-Colas of the world.
Exactly. And the margins on retail media advertising are astronomical, often north of 70 or 80%. They are effectively turning their delivery interface into a high-margin digital billboard.
Every single lever they are pulling, the physical remodels, the subscription pilot, the media network, is designed to extract compounding efficiency and aggressively steal market share from slower-moving competitors.
Which brings us to the verdict for today.
Let's hear it.
When we synthesize the entirety of this deep dive, the ability to outrun extreme weather headwinds, the massive 65 basis point margin expansion in a highly inflationary cycle,
the masterful execution of the $1 price point driving traffic growth,
the systemic reduction in shrink, and the deployment of an 18,000 store micro-fulfillment delivery network. The conclusion is pretty undeniable.
For the retail investor evaluating this space, the data dictates a highly convicted, unapologetically bullish stance.
Dollar General is executing at an absolute elite level. I mean, the core thesis here is that they have constructed the ultimate hybrid asset for a volatile macroeconomic environment.
They offer the defensive downside protection of a consumer staple combined with the aggressive offensive growth potential of a market disruptor.
Exactly. When the macro environment worsens and inflation bites, their core demographic leans heavily into the predictability of their $1 merchandising out of pure necessity.
And simultaneously, that same economic pressure forces the affluent six-figure household to abandon premium retailers and seek refuge in Dollar General's aisles.
They have effectively engineered a business model with a built-in bidirectional hedge against inflation.
So if you are an investor managing a portfolio right now, and you want exposure to a company that can effortlessly absorb supply chain inflation, actively mitigate the retail shrink epidemic, and leverage its massive rural footprint to dominate the last mile of delivery, Dollar General is a definitive buy.
They aren't just surviving this brutal economic storm, they have meticulously built a machine designed to run faster because of it.
Well said.
However, we never conclude a deep dive without forcing you, the listener, to look past the immediate quarter and confront the structural risks.
Right, there are always risks.
Which brings us to a highly provocative final thought for you to integrate into your risk assessment of this stock.
What's the main concern?
We have detailed how heavily Dollar General is currently feasting on the massive influx of the $100,000 plus trade-in consumer.
Right, that affluent cohort is padding basket sizes and driving margin expansion through discretionary purchases.
And generally validating the company's aggressive growth narrative. But the permanence of that consumer behavior is the multi-billion-dollar question here.
Because right now, Dollar General is acting as a highly effective lifeboat for a financially stressed upper middle class. But macroeconomic cycles eventually turn.
Exactly. What happens to this traffic data when the Federal Reserve finally manages to wrangle inflation back down to a stabilized 2%?
Or what happens when global supply chains fully normalize, auto insurance rates plateau, gas drops back down to a comfortable level, and the six-figure earner suddenly feels flush with disposable income again.
Have the physical remodels, the expanded fresh food offerings, and the sheer convenience of 30-minute delivery fundamentally and permanently altered the brand perception of Dollar General for that wealthy demographic?
Will they continue to shop there out of genuine preference?
Or is Dollar General simply renting these high-income customers until the economy improves?
That's the danger. The moment the financial pressure releases, does that 100K shopper instantly abandon the discount aisle and immediately migrate back to the premium supermarkets?
If they're only renting that demographic, the future same-store sales comps could face massive downward pressure when the macro environment eventually flips.
But if they have successfully converted even a fraction of those affluent shoppers into permanent, loyal customers, well, the ceiling for this stock's valuation is exponentially higher than the market currently understands.
It is a phenomenal behavioral economics experiment playing out in real time across 18,000 local communities.
It really is.
And it is exactly the kind of complex, evolving dynamic you must continuously monitor as you manage your capital. Thank you for joining us for this extensive, data-driven deep dive into Dollar General. Stay objective, keep questioning the consensus, and keep watching the tickers.